In Chapter 8, we discuss the valuation of inventory for acquisition and ongoing measurements. In this chapter, we focus on the subsequent measurement of inventory. In this section, I'm going to introduce two methods. One is LCNRV, the other is LCM. Circumstances arrive after the purchase or production. That indicates the company will sell the inventory for less than cost. So for the existing inventory, they are subject to damage, deterioration, obsolescence, and the reduction in the sales price. So this all reduce the ability of the company to sell, or it reduce the value of inventory. So it is reasonable to write down the book value of the inventory accordingly. GAAP require the companies to evaluate their unsold inventory at the end of accounting cycle to test whether the inventories are overvalued or not. As I said, there are two approaches to evaluate your inventory. One is lower of cost and NRV. The other is lower of cost or market. This is their application and their impact on the financial statements. Since these approaches are intended to write down the book value of inventory, we will see the assets will reduce, and also the cost will increase. Therefore, the earnings will be reduced. First, LCNRV. This method basically compares the two values. The cost, it is the book value of the inventory. The other is net realizable value. We are going to choose the lower value as new book value. The old book value is already known to us. It is a number amount recorded in the balance sheet. How to determine the NRV? So the formula to calculate the NRV is estimate selling price subtract cost of completion, disposal, and transportation. So these costs actually is to realize the value of the inventory. The difference is net realizable value, or NRV. This also represents the amount of payments or cash to be collected from the existing inventory. Keep in mind, this method is only applied at the end of accounting cycle, which is an adjustment to the financial statements, and it is also a adjusting journal entry we introduced. If we have NRV, we will compare with the book value. If the NRV is lower than the cost, this cost represents the old book value. So the book value is overstated. Then we use the NRV to replace the old cost as new book value. If cost is lower, we keep using the cost or old book value, and we do not write up the value of inventory. This is one of the characteristics of GAAP, the asymmetric accounting treatment for good news and bad news. That's also conservatism of financial accounting. The LCNRV can be applied to individual items or category or by total. So in this example, there are 5 products and 2 categories. A, B, C, D, E are individual items. A, B, first category. C, D, E, the second category. If we apply LCNRV at product level or individual item level, we basically compare the cost and NRV of each item. So for example, for product A or inventory A, cost was 50, NRV was 85. So we just use 50, which is the original book value. For B, NRV is lower, we use NRV. C, we use NRV. D, NRV. E, cost. Okay, so finally, we have the LCNRV for each item here. Then the sum of them is total LCNRV. Then we'll compare the cost. 415. The difference is the value of inventory to be written down, or the cost or loss to be recognized. We can also apply to a category level. So for A and B, the first category, the total cost was 150, total NRV was 175. We keep using the cost because cost is lower. Even for product B, NRV is less than the cost. For the second category, we compare the total of this category. Since total NRV is less than the cost, so we use total NRV for this category. Finally, the sum of both we compare with the cost. Again, the cost is greater than the NRV, so we use the NRV. But this NRV is different from the individual item level. We can also apply to the total. Total NRV was 431, which is greater than the book value. So we keep using the book value. See, the application at different levels will have different impact on the financial statements. So you should know the methods the company applied for their inventory. And the journal entry is also very simple. For a smaller amount, we usually debit cost of goods sold because this is written down of inventory, and then we also credit inventory. And we assume we're using the individual item level, so the amount to be written down was the difference between cost for 15 and NRV by individual level 395,000. So the difference is $20,000 decrease. So we credit inventory and we debit cost of goods sold. This is an adjusting journal entry. We recognize an additional expense and write down the value of asset. If the amount is large, so we may use loss. And usually large written down is unusual. So we may debit loss, adjusting cost to NRV. We are asked to apply lower of cost or NRV. We have the cost, replacement cost, selling price, cost to sell. We need to first calculate what's NRV. The NRV, remember, is estimate selling price, subtract cost of completion, disposal, and transportation. So here is 52, so 240. 240 is less than the book value, 270. So we write down book value by 30. We will debit cost of goods sold and credit inventory by 30. But this question doesn't ask that much, so it asks what's the value. And we use NRV to replace the old book value, 240. The next method is very similar to the LCNRV, is LCM. We will compare the original book value or old cost with the market value. Here is not the real market value. It is a designated market value. It is determined by three values. One is net realizable value, which is consistent with the prior method. The other is NRV subtract normal profit margin. And these two define the range of the market value. floor, and ceiling. So ceiling represents that's maximum, while floor means the minimum. And the market value actually is between these two. Another variable participating in this method is replacement cost. The cost to replace or reproduce the existing inventory. In this chapter, this variable will also be given. And what is the designated market value? We basically choose the value in the middle or between ceiling and floor. Okay, first let's calculate the ceiling and the floor. For the ceiling, for each item, we calculate its NRV. NRV is selling price subtract cost of selling. So for item A, it was 85,000. Normal profit margin is 20% of selling price. So 20% of 100,000, 20,000. So NRV subtract normal profit margin, 65. So here you should be careful. This is 20% of selling price. Okay, don't multiply NRV. It is 20% of the selling price. We keep doing this for the rest of items. B, C, D, E, we have the ceiling of each and the floor of each. That's the two inputs of LCM. Next, replacement cost. We have the ceiling, floor, and then replacement cost. For item A, 55 is under the floor, is below the floor, so we use the floor. Replacement cost of item B is greater than ceiling, so we use ceiling. Replacement cost for item C is between floor and ceiling, so we use replacement cost. D, it is greater than the ceiling, we use ceiling. 92, between ceiling and the floor, we use it. So finally, we have the market value. We have market value, then we compare to the book value, the old cost, and use the lower value. So cost 50 for item A, market value 65, we use cost. B, we use market. C, we use market. D, 85 is less than 90, we use market. E, 92 is less than 95, we use 92. So the new book value of each item is listed here, and their total is $387,000. And the difference is 28,000 adjustment. So we will debit cost of goods sold for 28,000 and credit inventory. If the loss is substantial and unusual, we will use loss accounts. And this is loss due to adjusting cost to market. Similar to LCNRV, we can apply LCM at product level, each item, or we can apply to the category level. We can also apply to the total by comparing the total book value and total market value. We can also see the results are different. Again, when we analyze financial statement, you should know what methods the company applies. Okay, so here we have the given information, cost. And then the next is what is the market value? To determine the market value, we need the ceiling. Ceiling is the net realizable value, which is expected sales price subtract cost of sale. It's 52, that's 240. The floor is 240, subtract normal profit margins 31, so it's 209. Replacement cost is 225, which is between, so we use 225. The answer is 225.